Welcome to First Citizens Bank Money Matters series. Our topic, investing in today's complicated world. I am Penn Nugent, the manager of the Personal Strategy Group, and am joined today by Phil Neuhart, the manager of our Institutional Strategy Group. Before we begin, please take a moment to review this disclosure. Let's begin. Today, we thought we'd share with you some of the recent conversations our teams are having with both clients and prospects. It's an amazing time to be in the advice business. We are having a lot of conversations, and we continue to hear a similar underlying theme. Why would I invest in today's complicated world? Or put another way, why should I stay invested in today's complicated world? Phil and I hope you enjoy our conversation and can use some of what you're about to hear. So Phil, I'll be the client. I've read our First Citizens Capital Management research as well as our recent market update. I know we expect volatility and certainly not a straight recovery, but I'd like to talk more about this. I need some advice. I've got some topics I'm worried about, and let me hit you with the first topic. The world is crazy. Why would I ever invest in it? There is a global pandemic going on. COVID-19, it, for most of us, is our first global pandemic, and it has brought the U.S. and global economies to their knees. This map from Johns Hopkins demonstrates the severity of the spread in the U.S. and would suggest we are far from under control. I'm definitely worried. There are more than 6.5 million U.S. cases and more than 29 million globally.
It's a great question and a great point. From a market perspective, the market did price the virus and economic shutdown during its severe sell-off in February and March. But as will be a theme today, the market is forward-looking and now expecting better times ahead, including apparent progress on both the treatment and vaccine front. That said, it's not all smooth times ahead. There is still a great deal of uncertainty in the near term.
Okay, well, let's say that's true. There is still more. I mean, aren't some states starting to actually re-shut down now, and isn't back to school not going as well or as ideally as hoped? And what about hospital capacity? I've read that this is becoming a concern again. And last, what are the chances that a vaccine actually happens? I mean, I know Russia has suggested that they have approved one already, but I have heard that it's possible it could take 3, 4, or even 5 years to create a vaccine, and history actually supports this.
You're right. It is not the number of cases that directly affects the economy and corporate earnings. It's the governmental response to those cases. As we have seen throughout this pandemic, key variables change quickly, but hospital capacity has improved nationally and yet is worth monitoring closely at the state level for both health and economic reasons. If we turn to slide 5, we are seeing hopeful news on the COVID-19 vaccine front. With a number of vaccines currently in human trials, there is a chance we could see vaccines available on a very limited basis late this year and more broadly available in 2021. In particular, progress toward potential vaccines from Pfizer, AstraZeneca, and Moderna give us reasons for optimism. If pharmaceutical companies are able to deliver vaccines late this year or early in 2021, even with limited availability, the development speed would have been historic, as the chart on slide 5 shows. We do expect fits and starts on the road to both economic recovery and the path of markets. As states take actions to slow COVID-19, these course corrections will inevitably affect the path of GDP growth, the labor market, and corporate earnings in coming quarters.
Well, let's just say we do get through the pandemic and these vaccine concerns. I'll now take you to a more traditional market concern. We've got an election, and it's a presidential one, and it's in less than 60 days. I continue to read that my candidate isn't going to win. I know it. And as a result, I know the market will go down. Even worse, I recently read if one party controls Congress and the presidency, it is bad for the markets.
Right. We're hearing this a lot, and we heard the same thing 4 years ago. Some clients made tactical decisions 4 years ago under the same belief that their candidate would not win. If we address the statistics on slide 6, while interesting and maybe surprising in certain cases, all of these are low sample sizes. Let's pick one. a split Congress with a Democratic president. Really good returns, but only 4 years are represented. This is an incredibly small sample and tells you very little. Although interesting, this is not significant enough to make any investment decision. Additionally, even in breakouts with larger but still small samples, if you dig deeper, you would find a range of outcomes is wide, and the average might be misleading. In the near term, the market is better at pricing the outcome than we are. Focus on fundamentals, what is the path of the economy, and corporate earnings.
All right, well, let's move to some economic topics. How about we start with my concern about future growth? GDP fell 32% last quarter, and I keep reading that was the worst ever. I mean, ever in the history of tracking it. How can it possibly be a good time to invest in equity markets? Is it going to take forever for growth to come back to this country, let alone globally?
You're correct. We experienced an incredible economic contraction, as you can see on this slide, in the second quarter, and the stock market reacted. The market reacted, declining 35% through March 23rd. It is interesting how the market called it ahead of time. The market is forward-looking. It fell ahead of the GDP results that came after. And if we turn to slide 8, you can see the economic consensus expects a material bounce back in both the third and fourth quarter. That said, we have a lot of wood to chop, and it may be a painful path forward, but we believe the worst of this is behind us.
All right, well, let's talk another economic topic. How about retailers and the labor force? All I see in the news recently is bankruptcy after bankruptcy. I've shown a few here on slide 9 that immediately came to mind thinking about this. It seems to me that the trend is increasing. What's going to happen to commercial real estate? Are the malls going to close? Feels like more retail bankruptcies are what we should plan for.
Well, let's turn to slide 10 for some context. As you can see here, retail bankruptcies are common during a recession. And the unfortunate truth is many trends that were harming brick and mortar retail over the last 10 to 15 years were accelerated by COVID and the pandemic and the subsequent move to online shopping. Put simply, this was the final straw for a number of companies that were already struggling. That does not make it any less painful for employees and shareholders. It is also a blow to parts of the commercial real estate market. Yet, as recent news of Amazon potentially retooling mall space into distribution centers with large commercial real estate companies like Simon Property Group shows, as well as potential for industries like grocery stores moving from standalone to mall-based locations, ingenuity will help, at least on the margin.
All right, but with all that, aren't we in trouble creating new jobs, much less keeping the existing ones? The unemployment rate is higher than it's really ever been, except since maybe the great financial crisis, and we all remember how painful that was. So what's going to be different this time? Why would I want to invest in the stock market now?
Yeah, it's a great question and a really good point and a real concern. Let's take a closer look at slide 11. The white line in this slide is the U.S. unemployment rate, and the blue line is the S&P 500 or U.S. large cap stock. As you can see in the unemployment rate, this was a forced economic shutdown. It was very different and unique, our 2020 experience. Even in the great financial crisis of 2008-2009, the increase in unemployment was far more gradual, as you could see here. In good news, the unemployment rate has come down significantly already, but does remain high by historical standards. The market is looking to better times ahead, although it could be years before we are back at pre-COVID unemployment levels. What does it mean for the stock market? Well, let's look at the previous recession, 2008-2009 period. From March 2009, equity market lows, represented by the red vertical line in this chart, through the October 2009 unemployment peak, waiting to invest would have cost you a 50% up move. The market, put simply, is forward-looking.
All right, well, it's interesting economic talk for sure, Phil. Let's move to another topic. How about trade? You know it's bad when my 14-year-old daughter is asking me about trade policy with China. TikTok shutting down is her primary concern these days, and therefore it has become mine. The U.S.-China tensions seem to be ramping up. We have daily news references, we have tweets and rhetoric, not to mention conjecture on how China may respond. This can't end well.
You know, when we think about our thesis for fits and starts during this economic recovery, this is one of the significant risks that may not be talked about quite enough. it could develop into something negative with market impact. It's too early to tell at this point how it turns out, but something to keep a close eye on. Markets, as we all know, do not like uncertainty.
I hear you, but it feels like the market is ignoring much of what we've talked about when you consider the current valuation. Markets are at or near all-time highs, yet many people I know are going to cash. It's the softer time of year seasonally, and so why not just wait? Wait until the recovery is clear, or there's a vaccine, or the election results are known. Why not just wait? I think I'll go to cash now and wait and get back in after a pullback. I mean, what could possibly go wrong with that type of plan?
And as you can see here, and the market valuation is high by historical standards. But let's turn to slide 14. As Brent Ciliano, our CIO, likes to say, focus on time in the market, not timing the market. It can be tempting to try to sell out of stocks to avoid downturns, but it's hard to time it right. If you sell and are still on the sidelines during a recovery, it can be difficult to catch up. Missing even a few days of the best days in the market can significantly undermine your performance, as you can see here. As the chart shows, if you invested $10,000 in 1980 and missed the 5 best trading days, you would have 1/3 less dollars. The more big days you miss, the worse it becomes. Another interesting set of data points, 48% of the S&P 500's best days occurred during a bear market. Another 28% occurred during the first 2 months of a bull market when nobody knew it was a bull market yet. Thus, a staggering 76% of the S&P 500's best days occurred when most investors wouldn't want to be invested in the markets at all. So time in the market does matter. In the end, none of us can time markets, and while we might have more than a few reasons for concern these days, we need to stick to our plan, invest prudently, and have our eyes on the long term.
Well, thanks, Phil. Phil and I certainly hope you have found these topics interesting and relevant. Our teams of portfolio strategists are ready to answer your questions in partnership with our holistic wealth offering and are aligned in our belief that time in the market is what matters. As you know, we base our advice on customized client planning objectives matched with risk, goals, and time horizons. When our investment advice is coordinated with solid goals and objectives, as Phil just said, we assure our clients don't miss the most important days in the market and provide the best possible outcome.